So for today, our study on cash flow management. So this is a very important session for any business person, because cash flow is a very critical item in a business, in that it can actually help an entrepreneur to understand how the business is like the financial health of a business. So it's an important tool that can help any entrepreneur to really be able to analyze their business, and having knowledge of what cash flows is very key for us. So even for very experienced entrepreneurs, they can also be faced with this challenge because of just managing their inflows and outflows, so that the business is up and running. So that's why this topic is quite important, and that's what we are diving deep into today. So moving on into why cash flows is important. First of all, is that cash flows is it represents how your money moves, the in and out of your businesses, because it will tell you how, and it will also tell you how like where exactly is your money going into. Is it going into some capital projects? Is it going into your daily working capital? Is it going into your finances? So you are able to understand how your money is working, or where exactly is your money going into. Then also positive cash flows will basically tell you that you're having more money coming than having more money going out. And when you have a negative cash flow, it indicates that your business is struggling, because it means you're not having more money coming in, but rather you're giving out more, and this could actually lead to challenges of going concern, and also other issues with late payments to creditors, or at worst, you can end up in a scenario where your business is closed. So it's important to actually have that understanding of balancing your inflows and your outflows in any business setup. Then now there's also this interesting concept that most people actually struggle with. You might be having some cash flows, but actually your business is not making any profits. Because remember, cash flow will only represent what your movement of money is operating. Like you could be having the daily inflows and outflows, but in real sense, your business might not be actually making profits, but your cash flow might be in a positive position, but you're also making some losses. So while that represents the cash flow, so profit, on the other hand, is when a business person earns more income that can cover the business expenses. So in essence, the two concepts are very important for any business person to understand, because these inflows might not necessarily be representing your profits, but profits is also a factor of the margins that you have. So if your margins are a bit less and your expenses are more, then you might end up with instances where you're making losses, but your cash flow is positive. But the good thing for maybe such a business is that with the positive cash flow, then that means your business will still be able to run, because you are able to meet your daily expenses to run the business. Yeah, so those are the major concepts to understand as we get deep into the discussions for the day. Yeah, so now I'll invite Njihia to take us through a deep discussion on.
As a business person, you're aware of that cash flow can make or break your business. And it's important for you to analyze your cash flows. So in this first analysis we are talking about, it is more on the financial, in terms of financial statements preparation, how the accountants do it. But it's important to understand that cash flows are divided into operating, investing, and financing. So if you are running a business or you are aspiring business person, you need to understand that there are those operating activities are your ordinary activities where you are dealing with collections for customers, outside receivables, you are payments to suppliers, if you have employees, you are paying salaries, and you have other operational expenses. So these are your day-to-day activities, so which you need to take care of. Then we have the investment activities, maybe you need to purchase assets. So these are investment activities. Now, investing cash flows, then financing, things like loan, you have dividends, you have equity. So we have those categories of cash flows from the perspective of financial accountants. But it's important to, even as you make a decision in terms of cash flow, understand these categories. Move on next. So now there are some tools of analyzing cash flows. Just want to emphasize, if you have any question, kindly you can put it in the comment section, or even mute yourself, and we shall get back to you. So we have a few tools here, tools that are used. We have the quick ratio. Quick ratio is a ratio where if I want to assume, I don't assume that you understand what are current assets and current liabilities. So current assets are assets like cash, your debtors, in your inventory, that's stocks. And then liabilities are like suppliers, you have loans which are payable within a short period of less than 1 year. So ideally your assets should be greater than one of your current liabilities. So what I'm saying here is that if you took your current assets and then you divided by current liabilities, your current assets being your cash, debtors, and the stocks divided by your liabilities, that is your suppliers and the loans, then the answer you get is a number greater than 1. What I'm saying here is that your assets need to be more than your liabilities. So it's important, it's a good indicator, or even as a small business person, in terms of small SME, just evaluate a quick analysis, analyze what your assets are. Your short-term assets are not talking about long-term assets like cars or any other long-term assets. So analyze them and you can be able to just give you a good perspective of how you are doing in terms of your cash flows. And then there is also operating cash flow. This is the same thing. I'm talking about the same thing as the quick ratio. I'm not going deep into it. Then there's another concept I would like to go called the cash conversion cycle. So the cash conversion cycle is a cash conversion cycle is a cycle whereby you determine how your cash is flowing in the business, and it has a formula which goes like let me. So the cash conversion cycle is, the formula is, you take, if you're dealing with inventory, you take days inventory outstanding plus day sales outstanding and day payables outstanding. So days inventory outstanding, this means that how long does it take for you when you, for example, if you deal with stocks, like maybe you sell maybe you sell phones, or you sell some hard, in physical inventory item, how long does it take from the time you purchase it to the time you sell it? So for example, the time you purchase it to the time, or maybe you sell cars, maybe from the time you take it from the port to the time you sell it, it takes you 30 days. So let's say 30 days. Then then from the time you sell it to the time you collect your money. The second part of the formula is day sales outstanding. So how long does it take for you to collect your sales? How long does your customer take to pay you? So for example, so we said we talk about 30 days. Since maybe you're talking about someone, let's just assume someone who sells phones. So from the time you buy it to the time you sell it, it's 30 days. Then after selling it, your customer pays you within a phone. A phone, maybe assuming in credit, they pay within a month. We're just talking about just some rough or estimate numbers, 30 days. So the time they sell, you sell it, the time the customer pays you. And then the last part of the formula, days payable outstanding, is the time which you pay your supplier. So for example, your supplier, you pay them you're supposed to pay them in 30 days. For example, let's say 30 days. We are talking about 30 everything here. So you say 30 plus 30, which is the day inventory. You take 30 days to sell your inventory, 30 days to collect your sales credit in debtors, and then 30 days to pay your supplier. So you say 30 plus 30 gives you 60, and then less the time you take to pay your suppliers. So you take that less 30 for your suppliers, it gives you a balance of a total of 30 days. So essentially, it's a 30 positive. So essentially, here you're in trouble because you're taking about 60 days to get your money, and your supplier expects you to pay them in 30 days. So you'll have to get into your pocket to pay your supplier within 30 days before you collect your money from your customer. So essentially, the time that it takes for you to pay the appropriate position is that the time it takes for you to pay your supplier should be more than the time it takes for you to collect your money from your customer. So that is what cash conversion cycle, improving your cash flow. So number one, as I was talking from the cash conversion cycle, is accelerating your receivables. This is a very obvious and but it's very important that you collect your sales, you collect from your customers as fast as possible. And one of the key things that you can do is make sure that as soon as you have sold an item or you have provided a service, you invoice them promptly, so that they'll not be saying that I've not even received their invoice a week later. So that those gaps of invoicing will cause issues with cash flow. The second thing is making clear terms of payments. So it should not be ambiguous how long your customer should pay you. Ideally, in structured businesses, they even put it on the invoices that the terms of payment are 30 days or 45 days. So for a small business, ideally, it's not ideal to have such long days, but if you have big sales numbers that you're doing, then it's important that you give them maybe a week, I don't know, a day or two, because for a small business, cash flow is king. It's important to manage this. So make sure it's clear either on the invoice or you communicate on messages or WhatsApp, however you communicate with your customers that you expect your money in this given number of days. And then another thing is give them incentives. So if you listen, we are talking about that. If, for example, you give a customer 10 days to pay their debt, then you could give them a discount if they pay your debt within 2 days. So you tell them, you can even put it on your invoice, or your customers knows that if I pay my debt if my debt period, we have 10 days, but if I pay within 2 days, I will get a 5% or 10% discount. They'll pay. They are motivated to pay faster, and this helps in your cash flow. So it's good to motivate, because as human beings, we know that this kind of things motivate us. So it's important also to motivate your customers to pay you faster, because it's so good for your business. It's not good for people to remain with their money. So electronic payments, as you know, but in these times of age, we have M-Pesa, but we may have customers who will give you checks, post-dated checks. Kindly discourage your customers from this, because these are things that are going to really be limiting. But I find for small businesses, sometimes when you're dealing with big businesses, it's hard to control this, but try your best because sometimes big businesses may molest small businesses by giving you post-dated checks, even 3 months, 2 months, 30 days. And now them, they are managing their cash flow, but on your side, you are suffering because someone is giving you a check today. Okay, you'll be happy you've received a check today, but the check will be banked. The bank will clear it in 40 days, 30 days. So it's not good. So it's important, try and encourage electronic payments, M-Pesa, and that cash payments. Yeah, and that will be good for your business. So we're talking about optimizing payment terms. Make sure that you shorten the payment period that your customers are paying you. And another thing we want to add is that you if it's possible, encourage deposits, especially for those offering services or any other maybe items which require huge capital, because you can say you want 50%, 40%, 60% deposit, because this is good for your cash flow. And also I've seen, it's hata mtu akipotea na pesa yako, they'll not go with all of it. So, but it's good to encourage. Deposits are good for your cash flow and for your business, and even as a commitment. When someone gives you a deposit, it shows a commitment to the service or to the engagement that you are entering into. Moving on, so strategies for improving cash flow. So another thing here is sales. Sales is an important thing. So it's important that as a business, cash is important to have cash in your business, because you'll be able to meet your recurrent expenses, fixed costs like rent, salaries. You have to pay, licenses are coming up. So like, for example, like periods, like you have periods when you're coming up to when you have to pay rent, like you have salaries, you need to, you can do campaigns, but ordinarily should be able to do campaigns and selling things and doing promotions so that money is coming in. Money is coming in faster than it is going out. Or it's coming in at periods when fixed costs are about to come. Fixed costs like salaries, fixed costs like you have transport, maybe you things like that. Maybe as I was saying. So you can do marketing campaigns. Then you can do cross-selling that with the existing customers. You can tell them you can offer them maybe discounts if they sell for you. They refer you, or you can give them complimentary products. So essentially, this is marketing and sales. It's important. It's an important part of cash flow, and even royalty programs. I know for small businesses can be hard, but with innovation, with these types of innovations that we have, AI and all the likes, technology has improved. We can check as business people if there are platforms which help small businesses to have royalty programs like the way we have supermarkets, and even some pharmacies like Good Life have things like this. So these are things that will help with their cash flow. Another thing is diversifying your revenue. So as a business, it's important to diversify your revenue. So if you just have one income stream, and the sales are affected, then here you have a challenge, because your fixed costs, as I was talking about, salaries, you have rent, you have licenses, you have maybe other maintenance costs that you need to do. Maybe you run a motor vehicle it needs service, it needs fuel, it needs other things. So you need to so if, for example, you sell different, you need to diversify. It's important for your cash flows, so that if one income stream faces challenges, then another income stream will be able to support the business. So you can introduce new products and services, alternative sales channels, and strategic partnerships. For example, in my experience, I have seen like a big farm, but I think it's a good example. They sell flowers in Europe, but then they need licenses for exports. So both companies have licenses for exports, but sometimes because of challenges, the license for one company may be closed, but they have another company. When these licenses for this company are closed, company A is closed, they use company B, which also has export licenses. So they are able to still do the exports when they face these kind of challenges. So it's good to have options, alternatives, strategies that will help you to make sure the cash is coming into the business. I hope we are together. this far. You can put your comments and we'll respond. Next, we have now optimizing the operational expenses. So here we're talking about you need to review your expenses. For small businesses, I know sometimes small businesses may not be maintaining their records adequate in a proper manner, but it's important that you monitor and you have a structure in keeping your records, because if the records are not kept properly, they're not well monitored. So because when you monitor, you can be able to pick up where you are going overboard, where you could notice patterns, where things are being wasted. If you have employees or yourself, maybe you are not aware of how things are happening. Maybe small increases over time will become big to the business. So another thing is to negotiate with suppliers. Make sure you negotiate with suppliers. Always keep suppliers close so that you can always keep getting good offers, discounts, and then you can outsource non-core services. For example, if you're a business offering maybe some very specialized service, but then maybe you have even you could outsource your maybe a delivery to someone. Maybe you have a bike, you could outsource to someone else. Then now they bill you, and you don't have to worry about maybe paying the salary of that rider. You don't have to pay about maintaining that bike or a car, or even maybe you have books of accounts. You have outsourced to an accountant to just come to your business once in a while, so that you can concentrate on the core service. You don't have to employ an accountant there, a small business, because you'll have to pay someone every day there. They have running costs. You need to buy water. You need to pay internet. So these kind of things, outsource some of those things that are not core to your business. Yes. So let us continue. Managing payment times. As we had mentioned before, you need to make sure you leverage payment times. So if a supplier, if you as we talked about, negotiate with suppliers, so you need to push the number of days you can pay as far as possible. So if you start with a supplier, they say the first time is cash, and then as we continue, you can go back to them and tell them, now I've been coming to buy from you, can you give me 15 days? Then the next time you go, can you give me 30 days? But this can only happen if you also pay on time. But as they continue to give you more days, then for you now, in this hand, as for your suppliers, you don't pay, you wait up to the last, you extend as far as possible, so that you hold as much cash, more cash with you for business, for running of the business, for buying stock, for trading. So that helps you run. But you have to be faithful, so that this money that you're extending, that you're holding still in the business, it's not money that you now use to go buy some personal things. It's money that you're going to circulate more in your business. So the money needs to be circulating. It needs not to be sitting down in the bank or in some drawer. It needs to be circulating, to be generating income for you, so that when it comes to pay your supplier, you'll be able to meet your supplier. But it's important to negotiate. So it's important to prioritize payments for important suppliers, so that you do not fall into trouble with important suppliers. So even as we say that you negotiate and you extend your days, always make sure that your key suppliers are paid on time, because they are important for your business. So we can continue. So you have major expenses. These are capital expenditures. So here we're talking about that you need to plan for this. So if you want to buy a bike, maybe a small business, you want to buy a car, you want to pay a piece, you want to buy maybe you want to build a house, maybe a shop, or you need to plan for them, and you need to evaluate them seriously. You need to check what we call the return on investment. So for example, you're a business, you do supplies, and you ask yourself, do I need to buy a car? What is it going to, is it time? You need to check, is it time to buy a car? Is the return of buying this van going to be enough? Is it going to make sense now? You need to sit down and evaluate the return on investment. Then another thing is that you need to, there are options called leases, and you can buy or buy. So now you want to buy a car, you want to buy a machine. Do I lease this machine, or do I buy this machine? Especially for a heavy investment that require high capital. So you need, the leasing is cheaper in the short term, but expensive in the long term. But buying is expensive in the short term. You need to evaluate this, because when you buy, it will compromise your cash flows in the short term, but in the long term, it's good. So you need to evaluate, where is your business? Do I need money now, or do I have enough money to be able to buy that asset now? Yes. So then the other thing is to cost-effective investment strategies. So here you're talking about incremental investments. So it's better to make investments incremental, don't make sudden huge investments. For example, you start a business, then immediately you just make a sudden investment. You want to buy a machine worth maybe, like, say 5 million, 3 million, and this is a big hit in your business. Unless your starting capital is significant, you need to make it's advisable to make incremental investments so that you do not hit your cash flows. Then, as we said, review your return on investment. So it's important to always be strategic. Check the returns that you are going to get from your investments. So now we are talking about forecasting the cash flows. So it's important when you're making decisions, and especially even for operating decisions, operating activities, as we mentioned, is that operating activities are those for short term, like you buy stocks, you want to pay salaries, you want to pay rent. Then for major expenses, like you want to maybe to build the shop, you want to buy a machine or vehicle, the likes. So for both cases, it's important to evaluate so that you can avoid shortages of cash, as I was mentioning, so that you can make strategic decisions. And also, when you forecast, you are able to give, maybe you are a business at a point where you want to attract partners, you want to attract investors. So it's important. The cash flow forecasting helps you be able to show investors that you are well coordinated, you're well planned, you're planning your activities in a good manner. So let us dive in more into cash flow forecasting. So how do you prepare a cash flow forecast? So you start with your current position. You need to know what your current position, what is your current cash position. You need to check your current data, how your customers are paying you, how you need to know how long you take to pay your customers, your daily, monthly expenditures, how much do you spend in a month, in a quarter, like that, in a semi-annually, annually, so that when you're able to know how current patterns, you can be able to look into the future. Then you go to estimating income. So you can estimate, but how do you do estimation? You do estimation based on past trends, or maybe you have you have contractual obligations. For example, you have expected sales. Maybe you deal with very structured businesses where you have a contract, so you expect that I'm going to receive. Yeah. Okay. I'm probably someone with a question. You can unmute yourself. Okay, we can go on. You can put it on the comment section. Okay, so we are talking about forecasting, estimating the future cash flows. So you need to anticipate how much using, maybe you have contracts, so you expect, or you have maybe you have some bills, you expect to be received in the next 3 months, 4 months. So that's how you can do a forecast. Then you can also project your cash flows, like those ones that salaries, you have rent, you have licenses, you have tax obligations, loan payments, and the likes, capital expenditures that you've planned. So these are things you'll also put into your cash flow. Then you need to be adjusting this in terms of, you have to also consider time. So you should not forget that these things are open over a period of time. So you have to be realistic. Don't be unrealistic. So as we know, there's inflation, or you could know maybe there are tax laws that are changing. Maybe you have rent, you have you lease agreements. You're going to, the rent is supposed to increase. Salaries, maybe you expect to increase salaries of your staff. So you need to be realistic. You don't shortchange yourself. So you start with the current position. Then you go to the incomings. You estimate expected incomings, projected outgoings, And then the important thing, be realistic. Adjust them according to the contracts, the changes in the environment that you're operating in. Then from that, you'll be able to realize, to come to a cash flow forecast, which is important for you in making decisions. So we go on to another thing called cash reserve. So here we're talking about, it's important for business to maintain a buffer, because it's important, as we know, even as we're told to save for a rainy day, unexpected financial challenges, obligations that may come in. And here we have three kinds of funds. We have an emergency fund, we have an opportunity fund, and we have and this helps with financial stability, just a fund for financial stability. So an emergency fund is for unforeseen expenses such as emergency repair, sudden drop in revenue, so it's important that even as you are generating revenue, you put some aside for unforeseen things. Then it's important that you have an opportunity fund. These are funds for opportunities that arise, because you could be running a business, but you realize, for example, a baking business could realize that maybe there is something else another service they can add to their business, and an opportunity can arise and they don't have the funds to go into it. So there are things that they can arise and you need to act fast. So an opportunity fund helps with that. Then for financial stability, so it enables for credibility with their lenders, their investors, and your stakeholders, that you can show them that I have this fund and I'm stable. So these are important. It's important to have a fund. So even as we run even our own personal lives, as we all know, it's important to save for a rainy day. So the next thing, how much cash reserve is advisable? Ideally, some businesses, their standards, but now for SMEs, and even in personal finance experts tell us it's important to have 3 or 6 months of operating expenses. I know it's not easy to accumulate this, but it's kidogo kidogo, haba kwa haba hujaza kibaba. So it's small and you accumulate. So if you have not, or you are doing this, keep doing this. And it's important to have some reserve, as we are saying. And even assess the volatility. You remember like the COVID period, some things are unpredictable. So it's important that to have these reserves, to just read the news, look at the markets, and know how the volatility that is there. So even a high volatile business, maybe a business which affected maybe by global issues, or maybe even political environment. Like for example, we are going to in 2027. It's a time when some things, political environment affects the business. So like in 2026, it's important that business are able to beef up their reserves to deal with effects of political effects in 2027, because then we can have losses, we can have maandamanos, things like those. We can have election days, things like that, business basically, or other things that happen in the environment. So let us move on. So as I was saying, start small for building cash reserve. Allocate from your profits. Don't eat all your profits. Allocate some of it, invest, and save some. And then the other thing important, can't unnecessary expenses. I was saying review expenses. It's important that we are able to review expenses and make it a habit. Don't wait for quarterly or semi-annually. Have a record and review it. Always review it to make sure that you are cutting down and making sure expenses are not there. We don't have unnecessary expenditures. So now another thing for cash reserves. So for business, it's important to maintain a separate account so that you don't dip into it when things are tough. So, and you do not in by error use it when or in error, maybe an employee or yourself use it unnecessarily. And to review it, to make sure that it's growing, make it part of your review, that you review your cash reserve and use it wisely. Don't you need to, like, when you set up your cash reserve, you can write down what circumstances can I use this cash reserve. No, it's not for your operational expenses. It's for a rainy day. So, and this rainy day needs to be defined. so that you just don't dip into it anytime. So another thing is to leverage financing options wisely. So what's leverage? Leverage is credit facilities. Could it be equity? Could it be loans, credit lines? So here we're talking about that it's important that you use these facilities wisely. They are good. Loans are important. They help businesses because they can help you to achieve some goals which could take a long time to be able to get them, but they can also be a challenge to a business. So there are business loans, and you need to make sure that you check the payment terms and even the rates of interest. There's no point of a business taking a loan at a rate of 25% and the margins that the business is generating, say 10, 12%. Essentially what you're doing, the business you're doing is just servicing the loan and even eating into your capital. So it's important to obtain loans which are affordable, loans from SACCOs or any other credit institutions which offer loans which are affordable. So expensive loans where you get 25%, 20% are not good. Lines of credit, here I'm talking about overdrafts. So if you have a bank and a bank where you bank and you have established a relationship, so they can give you a facility whereby you can use funds beyond what you have in the bank. So they can allow you to use some money, additional money than even what you have in the bank. Maybe, for example, you need to pay staff at the end of the month. So the bank can allow you to use more than what you have in the bank, but you need to repay it at a certain period. But you need to make sure that you repay this as soon as possible to maintain the relationship and to make sure that it does not become a liability to you. So these are overdraft facilities are ways that business can use to manage their cash flow. So another thing is invoice financing. These are also through the banks. So if you run a business and you have a relationship with a bank or any other financing institution, you can, and maybe you have some material invoices, maybe you have supplier customers who you've sold, you have invoices, they're supposed to pay you in 30, 60 days. Invoices may be worth maybe 1 million or 2 million, 500,000. Let's talk about those numbers. And you need the cash now. You can approach these credit facilities, and they can give you cash in advance at a small cost, so that you can access the funds now, and then they will go and collect the money from your customers. So these are facilities which you can use to manage your cash flows. You can even, another one is equity financing. So you can invite investors, partners to put capital into your business, and this will help you to grow. So rather than going to the banks, now you have someone now who's invested into the business, they put in money, and then now you have arrangements on how you're going to run the business with the proper structures, and you can arrange this with lawyers, so that, because partnerships or investors need to be well structured to make sure that there are no exploitation, and they're clear, established the lines of operation for the partners or investors. We move on. So choosing the right financing option. I was mentioning the cost of capital. A business should not be in facilities where the rates of interest are higher than the margins that they make, because they're in the business then of losing money, and nobody is in the business of losing their money. So it's important that you evaluate your cost of capital. Repayment terms, you need to have flexible payment terms. If you need to check your SACCO, your bank, are they flexible? If maybe you go through a challenge, can they change the term, the period? Because you can have some banks or from institutions which are quite fixed or rigid. Then now you find yourself in quite challenging times. Maybe they can even some banks are not friendly. Like now, interest rates have been dropping in the country, but then they are still holding the interest rates at the old rates, the high rates. So we need to check the institutions we are dealing with. Are they flexible? Are they friendly to the business? The other thing, you need to assess how the financing option will impact your cash flows. So you need to check when you take a loan, your monthly payments, how are they going to impact your cash flow? If you have very high repayments on a monthly basis, then that's going to affect your operational activities. You will not be able to do other activities. So you need to make sure that the repayments you make on a monthly basis are enough to make sure that you also meet other expenses. Because if the repayments take over everything that your business is generating, then the business is going to go in a hold, and it's not going to generate cash flows even to continue operating. So let us move on. Tips for managing debt responsibly. I hope we are together. So tips for managing debt responsibly. You need to take purposeful borrowing. You need to, as you say, check your return on investment. You need to do the cash flow forecast as we talked about previously. You need to have a strategy so that you do not take loans which are going to drown your business. So you need to even plan how you're going to service your debt. As I was talking about in previous point, your monthly repayments, they should not be too high. They need to be, you need to balance the period of the repayment so that it does not affect the running of the business on an ordinary basis. And then you need to keep checking your debt levels. You need to check your debts. You need to manage them, that your equity, your loans, your overdraft, if you have overdrafts, so that you don't get into a cycle of borrowing, because you can get addicted to borrowing because it's money coming in. Then at the time you realize you are in too much debt, then you are killing your business and the business will drown. Okay, so now we are utilizing technology for cash flow management. So we are at the tail end of the webinar. So here we are just talking about technologies you can use. So we're talking about using software such as QuickBooks and Xero. So it's important for we are advocating for business to get softwares. They are free, so they are softwares which are cheap, even locally by local entrepreneurs, or have a system or an Excel even, or to be able to monitor. Because if you don't monitor, you use the old school way of maybe a book, and they are not able to have a proper view of all what's happening in your business, then you'll may miss some things when you're evaluating your business. So we advocate using of affordable softwares that are even locally made by local entrepreneurs, or even using tools like QuickBooks or like Excel, so that you're able to monitor everything, and with that you're able to know what's happening in the cash flows with all those tools and those ideas we've given in the previous slides. So there are specialized softwares, but for small businesses, maybe these are above maybe their budget. But what I believe is that it's important that we have the basic softwares like Excel and QuickBooks for our accounting or our record keeping. And an important thing is to monitor our invoicing, our payments, to have a system, whichever system you have, that even if you're not using any modern technologies, that you're able to monitor your invoicing and your payments. Yes, so we need to make sure we have utilizing technology for cash flow management. So if you are able as a business, automate your invoicing so that you invoice your customers as soon as you deliver the goods or the service. And you can even have alerts using WhatsApp. You need to be prompt to remind them about the payments they need to pay you a certain time, and even automated reporting. Systems like QuickBooks and Xero provide this, but if you are using manual systems or like Excel, you need to review yourself. You need to review as frequently as possible. Do not wait up to the end of the month. You need to be proactive so that cash flows problems do not catch up with you. And then retain financial insights. So these are things that are to do with if you're using softwares, because of the AI and advanced technologies, these things are on these softwares. So we encourage to use these softwares, and even local, as I keep insisting, there are local techs who have developed softwares which we can use. So we are coming to the end of our webinar. So we are talking about now, in summary, effective cash flow management is a cornerstone of successful business. As we have explored throughout this webinar, understanding a cash flow and analyzing financial statements, improving cash flows, managing outflows, forecasting future cash positions, maintaining a cash reserve, leveraging financing wisely, and utilizing technology are all critical components of a robust cash flow strategy. By implementing these practices, entrepreneurs can confidently navigate financial uncertainties and ensure operational stability and position their businesses for sustainable growth and success. So that's it from our presentation. As you see the summary, we have mentioned a few things. We've talked about understanding the cash flow and understanding your financial statements, improving your cash flows. We've mentioned methods of how to improve your cash flows, managing your outflows, forecasting, maintaining a cash reserve, and leveraging financing wisely, and lastly, utilizing technology. So we have come to the end